To achieve success in the great game of speculation, a man must first learn the topography of his own mental weaknesses. He must identify these traps, study their mechanisms, and develop an ironclad set of rules to avoid them. For the market is a relentless and unforgiving environment that exploits every psychological flaw with brutal efficiency. What follows is a clinical dissection of the 10 most common and destructive of these traps. They are the hidden currents and whirlpools that have wrecked more trading careers than all the bear markets and market crashes combined. To understand them is to take the first step toward navigating the market not as a helpless victim, but as a master of one's own mind. The first, and most pervasive, is the hope trap. This is the mind's profound and deeply human refusal to accept an unpleasant reality. A trader enters a position, and it moves against him. The ticker tape, the one true source of fact, is clearly stating that his judgment was wrong. But instead of accepting this fact, his mind springs the trap. He begins to rationalize. He tells himself, it is only a temporary reaction. It must come back. He stops being a speculator and becomes a man of faith, praying for the market to validate his initial opinion. He is no longer reading the tape. He is projecting his own desires onto it. Hope becomes a substitute for evidence, a warm and comforting blanket that shields him from the cold fact of his loss. The master speculator, the one who survives, has trained himself to be immune to this trap. He understands that hope is the most expensive word in the market. His rule is to act on the verdict of the tape, and nothing else. When the tape shows a loss, he accepts it as a fact and cuts the position without emotion or hesitation. He does not hope, he acts. The consequence of falling into the hope trap is the catastrophic loss. A small, manageable loss, nurtured by hope, is allowed to grow into a devastating one that can cripple an account. The consequence of avoiding the trap is the preservation of capital, the speculator's most precious asset. The hope trap is the ultimate denial of reality. It is the choice to believe a pleasant fiction over an unpleasant fact. The professional speculator is a realist above all else. He builds his career on the bedrock of fact, and for that reason, he must banish hope from his mental toolkit entirely. The second is the greed trap. This trap springs not when a trade is going wrong, but when it is going spectacularly right. The speculator has correctly identified a major trend and is sitting on a handsome profit. The stock has had a long, sustained run, and the tape is now beginning to show signs of distribution-heavy volume with little upward progress, a change in character. The undisciplined trader, flush with success, ignores these warning signs. He is mesmerized by his profit. The emotion of greed begins to whisper in his ear, it can go higher. Just a little more. He abandons his rational analysis of the tape in favor of an emotional desire for an even greater gain. He has overstayed his welcome. Livermore knew that the goal was not to capture every last point of a move. The goal was to capture the great, solid, middle portion of it. He understood that when a stock that has been a leader starts to act sluggish and heavy, the time to be cautious has arrived. He would rather sell too soon than too late. The greed trap leads the trader to hold on through the entire topping process, and often, to ride the stock all the way back down, watching his magnificent paper profit evaporate into a meager gain or even a loss. He held on for the last eighth of a point and in doing so, sacrificed the entire move. The disciplined speculator sells when the tape tells him the move is exhausting itself, not when his own greed is satisfied. He is content to leave the final, dangerous part of the advance for the fools. By avoiding the greed trap, he secures his profit and preserves his capital for the next great opportunity. The third, and equally common, is the fear trap. This trap is the inverse of the hope trap. It manifests as the inability to sit with a winning position. The trader enters a trade correctly at a pivotal point, and it immediately shows him a small profit. Instead of feeling confident, he is seized by a nervous anxiety. He is terrified of this small profit turning into a loss. The slightest normal pullback, the slightest hesitation in the stock's advance, feels like a mortal threat. The voice of fear commands him to lock in the profit before it disappears. He is thinking not of how much he can make, in line with the trend, but of how much he has to lose right now. Livermore stated plainly that it was never his thinking that made the big money for him. It was his sitting. The courage to sit tight, to hold a position through the inevitable minor reactions, is the quality that separates the small-time speculator from the one who captures life-changing gains. He understood that a stock does not move up in a straight, uninterrupted line. The fear trap causes the trader to snatch a series of small, nervous profits, while the great moves, the ones that build fortunes, pass him by. His account statement is a long list of tiny gains that are inevitably wiped out by the one large loss he was unable to cut due to the hope trap. The math is unforgiving. The master speculator has the courage of his convictions, a courage born of trusting the tape. As long as the stock is acting right and the general market is in line, he sits. He overcomes the fear trap by having a plan and by trusting the evidence of the market over the turmoil of his own emotions. The fourth is the easy money trap. This is the psychological flaw that makes a trader seek out tips, rumors, and shortcuts. It is a trap born of intellectual laziness and the naive belief that success in the market can be had without effort. He wants the profits of a professional speculator without paying the price in hard work. He listens to the broker, the talking head on television, the anonymous poster on a message board. He is hunting for a secret, a magic bullet that will relieve him of the arduous task of studying the market and thinking for himself. He does not understand that Wall Street has no shortcuts. Livermore was a relentless student of the market, a tireless worker. He spent countless hours studying the tape, analyzing market movements, and learning the character of individual stocks. He was a lone wolf who did his own thinking. He knew that a tip, even a good one, was a curse, for it taught a man nothing and made him dependent. The easy money trap always leads to hard losses. The trader who acts on a tip is acting on another man's opinion, not on his own reasoned judgment. He does not know when to buy, and more importantly, he does not know when to sell. He is a blind man being led by another, and in the market, both are destined for the ditch. There is no substitute for the hard work of analysis and self-reliance. The market pays for expertise, not for the ability to listen to gossip. The speculator who avoids this trap accepts that the only reliable source of information is the ticker tape, and the only reliable analyst is his own well-trained mind. The fifth and deeply personal trap is the ego trap. This is the inability of a trader to separate his sense of self-worth from the outcome of a single trade. He makes a trade, and if it goes against him, he does not see it as a simple business loss, but as a personal failure, an indictment of his intelligence. His ego cannot stand to be wrong. And so, instead of taking the small loss, he holds on, determined to prove that he was right and the market was wrong. This is the psychological root of the great sin of averaging down. Each new purchase at a lower price is not a strategic move, but an act of ego defense. Livermore, despite his immense success, approached the market with a profound sense of humility. He knew that the market was an impersonal force, far greater than any single man. His opinion was worthless until the market validated it. His ego was subordinate to the verdict of the tape. The ego trap is the most expensive psychological luxury a speculator can afford. It makes taking a loss an act of profound personal pain. It transforms an objective business decision into a subjective emotional crisis. The trader is no longer speculating on stocks, he is speculating on his own infallibility. The disciplined professional understands that being wrong is a necessary and frequent part of the game. His goal is not to be right on every trade, but to make more money when he is right than he loses when he is wrong. To do this, he must be able to take a loss without it inflicting a wound upon his ego. The sixth psychological trap is that of impatience. This is the gambler's itch for constant action. The amateur speculator feels that to be out of the market is to be missing something. He cannot stand the quiet of being in cash, so he forces trades where no real opportunity exists. He is addicted to the thrill, to the excitement of having a position. This leads him to trade on the minor, meaningless fluctuations, the wiggles. He is constantly buying and selling, getting chopped to pieces by commissions and the inherent randomness of short-term noise. Livermore knew that the vast majority of the time, the correct action in the market is to do nothing. He was paid to wait. His great successes came not from frantic activity, but from long periods of patient observation, culminating in a decisive move when a true, high-probability opportunity presented itself at a pivotal point. The impatience trap drains a trader's capital and his mental energy. It is a costly and exhausting way to trade. It is the confusion of motion with progress. A speculator is not paid for his action. He is paid for his correct judgment, and correct judgment requires patience. The master knows that a great opportunity is not a daily event. He has the discipline to sit on his hands and on his money until the stars align. The amateur, trapped by his own impatience, is always busy, and always, in the long run, losing. The seventh trap is a close cousin of the ego trap. It is the hero trap. This is the irresistible urge to be the one who calls the exact top or picks the exact bottom. It is a form of vanity, a desire to be hailed as a market genius. The trader who falls into this trap is constantly fighting the prevailing trend. In a powerful bull market, he is always looking for the top, making small, unprofitable short sales. In a declining bear market, he is always bottom fishing, buying stocks that are still in a free fall, trying to catch the falling knife. Livermore had no interest in being a hero. He was a pragmatist. His goal was not to buy cheap, but to buy at the right time. He understood that the safest and most profitable course was to join the trend once it was well established, not to try and anticipate its end. The hero trap is a recipe for a series of small, frustrating losses that slowly bleed an account dry. The market can remain in a powerful trend far longer than the would-be hero can remain solvent. He is trying to stop a freight train with his bare hands. The professional is content to be a coward, to join the crowd once the direction is clear and to get off the train before it reaches the end of the line. He leaves the heroics, and the inevitable losses, to the amateurs. The eighth is the recency trap, a form of mental complacency. The trader experiences a certain type of market, a wild, speculative bull market, for instance, and his mind begins to believe that this condition is permanent. He forgets that the character of the market is always changing. He becomes reckless. He abandons his rules for risk management because, in the current easy market, every mistake is being rewarded. He takes on too much leverage. He stops doing his homework. He believes the easy money will last forever. Livermore, having lived through multiple booms and busts, knew that nothing is permanent on Wall Street. He was a keen observer of market character. He knew when a tired bull market was on its last legs, and he knew when a bear market had finally exhausted its selling. He adapted his strategy to the conditions at hand. The recency trap leads to ruin because when the market's character inevitably changes, the complacent trader is caught completely unprepared. His loose, reckless habits, which were profitable in the bull market, become fatal in the new, unforgiving bear market. He gives back all of his gains, and more. The speculator must never forget that he is dealing with a dynamic, living entity. He must remain a vigilant student, always adapting, always respectful of the market's power to change its mood without warning. Complacency is the enemy of survival. The ninth is the narrative trap. This is the tendency of a trader to fall in love with a stock story. He reads about a revolutionary new technology, a visionary CEO, or a massive new market, and he becomes a true believer in the company's narrative. He becomes so attached to this story that he begins to ignore the only evidence that truly matters, the action of the stock on the ticker tape. The story may be wonderful, but if the stock is in a persistent downtrend, the tape is telling him that the big players, the insiders, do not share his enthusiasm. Livermore was not an investor in stories. He was a speculator in price action. He did not care about a company's stated fundamentals or its grand promises for the future. His one and only concern was how the stock was behaving right now. The tape was the final arbiter of a stock's true worth in the marketplace. The narrative trap is dangerous because it provides a powerful emotional reason to hold on to a losing trade. The trader tells himself, the market is wrong about this one. In the long run, this story will win out. This is just a more sophisticated version of the hope trap. The professional speculator trusts the tape over the story, every time. He knows that the tape reflects the sum of all knowledge and all opinions about a stock. To bet on the story against the tape is to bet on his own limited judgment against the collective judgment of the entire market. Finally, the 10th trap is the blame trap. This is the psychological mechanism that prevents a trader from ever learning from his mistakes. When he suffers a loss, he refuses to accept that it was his own fault. He externalizes the blame. He blames his broker for a bad fill. He blames the market makers for running his stops. He blames the algos for creating a rigged game. He blames a sudden news event for his bad luck. He has an endless list of scapegoats, and his own name is never on it. Livermore insisted on accepting absolute personal responsibility for every single trade. A profit was the result of his correct judgment. A loss was the result of his incorrect judgment. There was no one else to blame. The blame trap is a powerful barrier to growth. A man who does not own his mistakes is a man who is doomed to repeat them. By blaming an external force, the trader denies himself the opportunity to analyze his error, to learn the lesson, and to create a new rule to prevent its recurrence. The speculator who avoids this trap keeps a detailed journal, not just of his trades, but of his reasoning and his mistakes. He performs an honest, unflinching autopsy on every loss. He accepts his failures as the necessary tuition he must pay to the market for his education. And because he learns, he eventually graduates. The man in the blame trap remains a freshman forever.